So thank you all for participating. Just to be true and transparent, this video is getting recorded. The whole idea is of the objective of this webinar is to first give you an update on the key things that have happened after yesterday's budget. What is a, we want to just present it in a nutshell. That is one. And second is we've been working on rebalancing our portfolio for our clients. So we will take this opportunity to explain why we are doing the rebalancing, what are the changes that we're making, and what is the reason why we're making those changes. So that is something that we will cover up in the next 30-40 minutes. My request to you is you can type in your questions whenever you feel that there is a question to be answered. We may answer it during the course of the webinar or at the end of it. But let's say if you want to talk, let me know. I'll actually unmute you and we can talk or ask your question as well. Once again, thank you for joining on a Sunday. I'm here with Naveen. Naveen is the co-founder, CIO of the firm, and Mohit Bagdi is a founding member, and then he's the head for investments. So initially, Naveen will take it, and then Mohit will then add in his views, and that's how we'll do the rebalancing part as well. So Naveen, if you could just start.
Hi everybody. Thanks for joining today. Let's. We as anybody else, we have been carefully watching the budget yesterday, and some of the things, and actually the main thing which we were hoping for, and we were not sure if it will happen, has actually happened, right? And to get into more details about that. Mohit, if you can go to the next slide. Yeah, so the biggest thing that happened uh, was the tax changes, income tax changes. Pretty much, most of most people will get 1 lakh rupees extra into their pockets, and that really makes a big difference for people who are earning, say, around 15 to 20 lakhs. It makes a big percentage of their income. It is almost like a salary hike they are getting. So that is going to add a big bang uh, to their incomes, uh, which which is explained in more details in the slides. Uh, so Mohit, if you want to go over those details.
Yeah, I hope I'm audible. As Naveen mentioned, that this was one of the biggest boosts which came out from the budget this time. To just give from a number perspective, uh, the amount of income tax which is going to be foregone by the government is about 1 lakh crore. Now, the same 1 lakh crore which is getting saved due to the taxation benefit given through the exemption will now move towards the consumption economy, and that's where the economy is supposed to get boosted up, and that's the market reaction which we saw yesterday. The basic thing which came up was up to 12 lakh. The amount of taxation which was earlier up to 7 lakhs is now exempted, and there are also changes in the taxation based on the tax slabs. So we have given the illustration on the below, that if you are earning about 24 lakh income, the benefit which you're going to get now is 1.1 lakh rupees, which is extra in someone's hand. And if the number is about 18 lakhs, it's about 70,000 rupees. That's the extra income which is getting created out here in the hands of the middle class and the lower class. And that's where the government feels that the consumption economy will more or less revive on that front. One of the points which was getting heated up amongst all the discussions which were happening across uh, the fraternity was if there is going to be any tinkering with the capital gains, which is on the equity taxation, which was earlier 10%, and in July 2024 they had increased it to 12.5%. There was quite a bit of discussion that this might move towards a 15% rate, but fortunately the finance minister hasn't tinkered with those numbers, and probably the expectation is not to change it, because there have been a lot of FII outflows which is happening in the capital markets, and they would want that capital markets to be stabilized so that it does not create a lot of pressure on the INR also, because when FII take out money, that's where the dollar demand gets created more. So that was the basic changes which were happening in the on the income tax side, personal income tax. One more point which the finance minister alluded to is next week they are going to present the new tax bill, which will have further details into how the complicated taxation is going to be simplified going forward. Let it be your income from rentals, real estate, other incomes, maybe cryptocurrencies, and other type of income. So those kind of things are going to definitely get changed, and that's where 1 week from now is where we get more details. So that was on the income tax changes which broadly came through. Just one more point which I want to add is one of the biggest changes which happened yesterday, and that created a very good impact on the real estate side, was earlier there was the government had allowed one self-occupied property where you would have to not pay any income tax, and if you had more than one on the other self-occupied property, you would have to pay a notional tax. Now the finance minister has said up to two houses, it's exempt from income tax, and that is why the real estate segment overall got boosted up in the stock market also. And because the expectation is people will now, without worrying about more taxation, they would want to have another house if there's more money in hand.
So, Mohit, I had a question around this. Few people had already asked. Maybe I'll just pause it here for
Sure.
you. So, what do you mean by this real estate thing that you mentioned? Saying if I have one single house, and if I had the second house, that was considered as a rented property. So I had to look in for rental income. Is that what you're saying? Well,
Correct. So even if the second house was not given for rentals also, the Income Tax Act says you had to include in your income a notional rent, which would be based on the market value.
correct.
That income you had to take as part of your income tax and pay tax on it, in spite of not putting that house for rentals. So that's the benefit which the finance minister has said. Even if you have another second house, there'll be no taxation or no notional rent which you would have to include in your income tax.
Okay. So that means that if I have two houses, now no more assumptive income of rental that I
Exactly.
for.
Yes.
Okay. And one other question that a lot of people ask, and I'm just talking on their behalf, Mohit. By the way, Mohit is a chartered accountant. So if you have any questions around taxes, he's the right person to ask. Mohit, is that, let's say if I have 12,76,000 as my income,
Hmm.
fine. Let's say 12 lakh 1,000 as my income, and because of exemption and whatever that 75,000 rupees, what for that 1,000 rupees do I end up paying significant amount of taxes?
So there's a calculation which was floating around, and I'll give you overall view on it. So since as per the new tax change, up to 12 lakh, there's going to be no taxation.
Right.
Now, if let's say someone has about 12 lakh 1,000 rupees as your overall income. Now, if I go as per the tax lab, which is on the right hand side of the screen, if someone tries to calculate what is the income tax because you're not below the 12 lakh exemption limit, the number would come around 66,000. Now, someone would say, just because of 1,000 rupee, do I need to pay 60,000, 66,000 of income tax?
Yeah.
That's where there's a regulation in the Income Tax Act, which is called marginal relief. The Act says that if your excess income over the exemption limit or the taxation amount which comes, whichever is lower is what you need to pay. So 66,000 and 1,000 is your excess income above the exemption limit. So you need to pay only 1,000 rupees, because whichever is lower is what you need to pay. So that's where up to 12,75,000, you don't need to pay any additional income tax. You might be on the lower side of it. I hope you got the
So
point.
if I have 12,76,000, I just pay 1,000 rupees as tax,
Yes. Yes.
not 60 or 80,000 rupees and things like.
No. No.
Okay. So that's a key thing because people on LinkedIn, people everywhere were talking random numbers. So it's good to hear from you, Mohit. Sorry, yeah. Now you can go to the next slide if you
So I'll go on to the next slide. Yeah, I mean.
Yeah, one of the things the government has been repeatedly focusing on is maintaining fiscal prudence, and we have been watching this from the past few years, which is like running the house in order, not overly going on a spending spree and all. In fact, the loans have been coming down, and they continue to keep bringing it down. In that regard, one of the things the government is focusing now on is the capex has been increasing uh, at a good rate for the past few years. Now it is it is stabilized. The thought process behind that is the government thinks the existing capex should be enough, but now the existing government capex should be backed by uh, private capex coming and supporting. And there are some things which have been introduced in the current budget, which shows that uh, they are coming up with more private public participation models, which should help that. And another thing which is important is, regarding the uh, income tax reduction, is uh, how quickly the government responded to it. In the sense, we were when we closely watched the markets and the earnings, all of a sudden, surprisingly, the consumer spending came down in Q2. This was a bit of a surprise, and that was mostly in urban consumption. And we all know that consumption is a big part of GDP. Uh, Now, this happened 3 months back. Uh, and to applaud the government on this, they quickly took this action of reducing the taxes so that the urban consumption can boost again. Because at the end of the day, we need 7.5 to 8% GDP growth for a sustained long amount of time to reach the planned Viksit Bharat. So since we are slowly we were coming below the expectation, government quickly took that action. So that is a very laudable thing. Anything you want to add here, Mohit?
So that's the major point which was worrying, as Naveen alluded to, that Q2 numbers were pretty bad, and that led to some kind of expectation of slowdown, which was being seen between Q2 and Q3 also. So the government has taken a proactive action because the major driver of the decline was coming from consumption related segments, and while the rural part of the consumption was reviving post COVID, the urban, which is your metro cities, tier one, tier two cities, that is where the consumption was declining to an extent, which the government tried to answer with the taxation changes which has happened. And as I said, there's a 1 lakh crore which is now going to be foregone, is going to come back to the economy. So that is the balance which the government wanted to make, is drive the consumption back into the market, but at the same time try to maintain the path of fiscal prudence, which is a very major driver of India as it is seen at a global front. Now, the government had said FY26 they want to maintain a fiscal deficit of about 4.5%. Now, what is a fiscal deficit? It is a difference between your expenditures and your revenue. So, government, if it is earning 10 rupees and if they're expending 12 rupees, so that is the 20% of fiscal deficit. So, currently, the government has said from 4.5, they want to maintain a fiscal deficit of 4.4, while the difference is of only 0.1, but that brings a lot of difference when you see at an absolute term basis. So that fiscal prudence path leads to a lot of changes how India is seen at a global front from a interest rate yield perspective also. So India is trying to do one of the biggest thing is getting a rating upgrade at a global front. So if I'm, let's say, as per Fitch, I am a triple A negative, India wants to go at a triple A neutral. That changes a lot of dynamics in terms of how the foreign investors look at India, because now they are seeing a stability in the overall economics of India, where the depreciation of rupee might be lower than before, the interest rate yields in India will be more stable, and it is not going to be a frivolous kind of an economy which used to be before due to the political instabilities. So that is the thing which the government wants to focus, bring solid stability in the domestic front, but more importantly also on the foreign front, so that India becomes a safe haven for the foreign investors to come and invest into India and keep the money invested into India.
I have a question, again, on behalf of people, just to simplify things, right? So, Naveen, the capex number has actually increased, from, let's say, the revised number of 10.1 lakh crore to 11.112 lakh. That's a 9.2% increase.
Yes.
One of the reasons that was floating around yesterday when the market didn't react very positively to the news was saying, okay, the consumer or the capex numbers were not very high. But it doesn't look like, right? It is still looking like a good number, like last year only. So,
Yeah.
I
Yeah.
mean, where is the issue? Where do you see it as a problem? Because there are two positives at least I see. One is 4.4% fiscal deficit, which is great. And then, so they're trying to achieve instead of 4.5, 4.4%. And that means they will not borrow more. They're expecting revenues to be more. On the other side, they're also doing the capex. So where is the issue then?
Here is the thing, right? Like past 5 years, the capex has grown from like 3 lakh, uh, 3 lakh crores to close to 10.5 lakh crores. And that growth is significant. It's a big number, around 20%, 25% or something. Uh, it is not the same level. Obviously, you cannot keep going at the same level, right? And one of the things what we are seeing now is it is just increased uh, uh, by 1 lakh crore more, right? And that might be adding to the disappointment is one thing. Second is I think in this budget it was not specifically mentioned in which of the public infrastructure impetus will be given. Those details might come later. There might be money reduced from some place going to some place. Especially people were hoping for money into railways, money into defense. That was not specifically mentioned. So that might have disappointed the investors temporarily. But what I feel the government is going for is more efficiency in spending. uh, and this is where they were talking about uh, PPP models, wherein now typically the way it happens is initially the government spends because of lack of spending from the private sector, uh, and then the private sector is expected to kick in. Now the private sector was not able to kick in now is because of the lack of demand, and that is where the government gave 1 lakh rupees extra into consumers hand, uh, which will add the demand, which should help private sector increase their capex. I think it is a well thought out plan, which will work its way through the economy and obviously in the earnings of the companies.
Okay. Yes, I think we are 20 minutes into it. This is a good and now I get it, but I think market needs to understand this to to see the difference, and then it'll take some time to see the difference. Is what I'm saying.
Exactly.
Yeah.
So these were the broad key points which further came in, and it tinkers to a specific points like the TCS limit, which was earlier up to 7 lakhs, that has increased to 10 lakhs, which gives a certain benefit to people who are maybe traveling or sending money abroad to family or friends. So that is a TCS limit which got increased. On education, they have specifically mentioned that they have removed the TCS taxation. And if you take a loan from specific financial institutions, As I mentioned, the new tax bill is going to be introduced next week, which will ease the tax compliances and maybe very much easy for individuals to also understand. The fourth one was 100% FDI in the insurance manufacturing space, which is like a life insurance or general insurances. This is a good move in terms of competition coming in India, wherein the prices of premiums, etc., could be moderate to an extent. And the last one was giving boost to the MSME and the startup segment by increasing the credit guarantee cover from 5 lakh, 10 lakh crore to 10 and 20 crores respectively. So those were the key broad points, while the specific details in terms of how much allocations of the capital expenditures has been done towards defense, roadways, railways, etc., will be further into the tax the finance budget document itself. But the broad theme is overall there have been a lot of positives, there have been lesser negatives, and more importantly, there were no negative surprises which came in as was there in the last budget. So that's the overall view which we had on the budget, and probably we'll now move on to the rebalancing. Just give me a moment. I'll just share my screen. And until then, Anand, you want to?
Yeah, I'll just while Mohit changes the slides. So the whole overall idea, what I see in summary, is that whether it is increasing the tax limits, increasing the capex plan, decreasing the TDS filing, increasing TCS limits. I think what the government has understood very clearly is that more money needs to be in the hands of people and not in their hands, and they make a call. So what I'm saying is, instead of government holding everything, they're now giving you or us the money so that we start spending on things that we believe it could be discretionary, it could be consumer staples, whatever it is, right? So this will lead to more and more money carries velocity. When it changes hands, it creates more GST. It could create better tax buoyancy and things like that. So I think in terms of budget, this ranks very well. It doesn't compromise much on anything. Surprised to see that they're still talking about 4.4% fiscal deficit in spite of giving away 1 lakh crore to people. What I believe is that this is a very, very smart, timely budget. You don't need to always have a visionary budget every time, right? Vikshit Bharat, okay, you need to do 8%, all that is fine, but that is a vision. I need to address today's problem, and that's what this budget is done very well. Yes. I would actually put a 9 on 10 on this, maybe a 10 on 10 on this budget, considering that we were going through a good amount of slowdown, which was not warranted for, and we shouldn't be. We are a buoyant economy. We should be going up and up only. So net, I really like the budget. No compromise whatsoever, whether it is on vision or on the doing the right thing immediately. So just to give you a brief on to the next section, for people who are joining now, is that we at Mira Money we launch wealth baskets where we create curated. We build baskets which has curated mutual funds. We have had multiple styles, multiple different types of baskets for various risk profiles. What we figured out was, early in January 2024 itself, back then is about a year now, is that mid and small caps were slightly, or a few of them were actually overvalued. And we very rightly back then itself changed our allocation to close to about 90% of our money in large caps and about 10% of our money in mid caps. This was in January 2024 when we started rebalancing the portfolio. For some time, of course, I do agree that it was under pressure because small caps did fall down and again recovered until about September, October. It was making us think whether we did the right call. Was it the right strategy to do and stuff like that? But we stuck to the, I remember talking to Naveen and Mohit multiple times saying, is this the right thing to do? Is this the right thing to do? And then we stuck to it. Fortunately, today, when I look back exactly after a year, that call has worked out beautifully for us, right? So for example, I may be a little wrong with the numbers here and there. Small cap is only up 1% since January 2024, while large cap is actually up by about 7, 8, 9% or so, right? So there's a lot of value creation that has been done, or alpha generation that has been done purely because we could actually get the call right, maybe a little early, maybe a little late. That is always a post-mortem. Now what we want to do is, and I'm very, very proud that we did it. Now what we want to do is, we want to make certain changes in the composition of the portfolio. That is one, to add a bit more of mid and small cap, which Mohit will talk about. Plus also add a couple of different styles of funds. And this section now, which Mohit and Naveen will take, is about what are the changes, why are we doing it, what is the implication of it. And if you have any questions, please do let us know.
You guys can see my screen, right?
Yeah. Yeah. So just to go over the background, uh, the n- the near past background in the last 4 months, what we have seen is the markets have corrected uh, fair bit, uh, though having seen the markets for the last 25 years, both in India and abroad, uh, this is there are bigger things which have happened, but this is in the near past. This is a fair bit of correction. If you can see there, uh, Nifty 50 has corrected the least, and we have around 75% of our portfolio in Nifty 50 in the current allocation, right? So we could cushion the fall better, and this was basically because when we did the last time, when we did the rebalancing and did the allocation, uh, so we followed two two things to look at what the allocation should be. One is the valuation, and second is the future growth potential. In both these things, we found that uh, the large caps, and specifically Nifty 50, was the best place to be, and that is what worked out for us. Uh, so so and that is what you're seeing here, how the markets behaved in the last 3 months. So going forward, and we continuously keep doing this analysis of the data, and also more importantly, we talk to close to uh, 20 to 25 analysts, fund managers, and economists every month, and we keep bouncing our questions to them, getting their ideas, getting their feedbacks, and and what we figured out is, like I mentioned when we were talking about the budget, in the September quarter, everybody was caught with a bit of a surprise uh, of the slowdown in consumer which happened, though capex slowdown was expected. So that hurt the earnings a bit more than what was anticipated. Because of this, we saw a we saw the even the GDP numbers were recalibrated. It is now expected that this year is going to end with 6.3% GDP. And one of the things we figured out in our analysis is, uh, when the market is on an upswing, when the broader market is in an upswing, like when the GDP is growing at 7.5%, everything goes up. So at that time, index is the best place to be, wherein it takes up every company earnings. But when the GDP starts slowing down, it becomes a stock pickers market. So so at this time, we will it is necessary that uh, we go with the assets which has a potential to show better earnings growth with the right valuation. And we in when the markets correct, uh, we get a bit lucky on the valuations, because the valuation starts getting reset. right? And at that time, when we go in for companies which have better growth, then you get better returns, and that is where we are planning to introduce uh, more active funds, some amount of active funds in the portfolio, but we are still sticking to uh, majority allocation going to large caps. You want to add anything here, Mohit?
Yeah, so I'll probably on the next slide I have further more details where I'll explain this thing which Naveen spoke in a much more detailed fashion. Let me just go on to the next screen. So, as Naveen mentioned, what we are trying to do is in our high growth index fund basket, we are trying to reduce certain exposure of passive, which is your index exposure, and adding an element of active fund exposure. Overall, post rebalancing, the portfolio will be into 60% index funds and 40% active funds. So that's the broader theme is where we would want to move the portfolio to, because as Naveen mentioned, whenever the economy is on a slowdown or it is reaping lesser numbers than the previous, which was around 7.5, 8%, that is when the market is about a stock selection. So the active portfolio, which is managed by a active fund manager in terms of finding the stocks which has the high earning growth capabilities and also at a reasonable valuation, is where the portfolio becomes more beneficial in such markets. While we continue to have a passive exposure of 60%, our overall composition still continues to be 80% into large caps and the remaining 20% into mid and small caps. We continue to believe today that large caps is where we find more earnings and also valuation comfort. So that is why the passive portfolio which we have of 60% is not into the mid and small. It is into the large cap space, which is Nifty 50, because that's where the earning growth continues to be there, where the valuation comfort is. So end of the day, from a risk to return perspective, that's a comfortable space to be in. And with the active portfolios, we are adding elements of certain large caps again, but with a tinge of mid cap and small caps also, because those are the stocks which will provide alpha, because those are the companies which might show better growth compared to your large caps also. So wherever there is a reasonable comfort, that's where the active fund manager takes allocation into the mid and small cap companies. They're going to be very selective with their approaches. It's not a broader based 150 mid cap index or a 250 small cap index. They're going to have 35 to 70 kind of stocks, which will kind of show those earning growth momentum along with the reasonable valuations. I'll just go on to the next screen where you will see further more details. So the reason for reducing passive exposure is currently because the broad-based indices have higher valuations in the order of mid caps, small cap, and then large caps. So further, the Indian economy, which is facing a temporary slowdown, that is the reason is why we would want to reduce the passive exposure. And during expensive valuations, as Naveen had also mentioned, indices compared to active funds tend to perform poor because the valuation is range bound and it is on the expensive side. So I'll indirectly have allocation into those stocks also through the index, which is continue to showing lower returns from a growth perspective, but still are at a higher valuation. So that is an element which we would want to reduce, not having those stocks into the portfolio, especially in the mid and small cap side. And that is the reason we are reducing our passive exposure in the mid cap and small cap space. So, and coming on to the point of why add active fund, as I've mentioned, those are very stock selective in nature from an active fund manager. The one biggest point which also gets added by investing into an active fund is that the active fund managers during volatile times has the capability to move the funds, means the money which is there in the fund, towards cash also. When I say cash, they try to invest about 5 to 10% money into the liquid funds. so that they can wait for the time when the market corrects is when they deploy that money to invest into those stocks which are at cheaper valuation. So that is one of the biggest benefit which is to be taken in the mid and small cap side, because they are on the higher expensive valuation. And as we have seen the month of January itself, when 10 to 12% of correction which has happened in the mid cap and about 20% in the small cap space, a lot of stocks inside has gone down by 20 to 40% also. So that is where the reasonable valuation kicks in, and the active fund manager will be able to take those calls of whether to buy these companies which is at a cheaper valuations. So those are the key reasons why we are adding active funds and why we are reducing passive funds. End of the day, as I mentioned on the headline, is the objective is to not just provide alpha, but also protect the capital during market drawdowns. So as I've mentioned, during a slowdown in economy, a passive fund might show lower returns than the active fund. So that is where we would want to move the fund into the active space.
Yeah, and one more thing is uh, selectively we still like the growth uh, we see in small caps, but the valuation is uh, very high right now. So we are closely watching it. If the valuation comes down or the growth goes above the expectation, which is a little less possible, we will be actively adding more to the small caps, particularly, and if the chance arises in the mid cap. So we'll be continuously watching for those things. Right now, we feel uh, the valuation to the growth, uh, uh, whatever we are seeing trade-offs, is not there at mid and small caps. So we are going selective there, and the allocation also is lesser.
Got it. Okay. Is there any further slide, Mohit, or I can? Yeah.
Yeah. So this is the final allocation which we'll have the as a portfolio after rebalancing. The first three are the existing funds which is there in the portfolio, which is the Nifty 50 index and the Alpha Low Volatility index. The three funds which we are adding is the Motilal Large Cap Fund, Nippon Large Cap Fund, and Motilal Small Cap Fund. So, as we have mentioned, the allocation will be out around 40% because that's the churn which we are doing on the portfolio by adding two large cap funds and one small cap fund. And we are moving out of the mid cap index, which is there in the portfolio, the small cap index also.
Okay.
And this is the portfolio mix, as I was mentioning. Post rebalancing, the large cap exposure continues to be at a 80% level. The mid and small will be around 17% with a 2% cash in your portfolio overall. And the bar chart which you see on the right gives you a overall picture in terms of where is the active element coming towards. 25% of the money is still towards large cap. The remaining 15% is coming in the mid and small cap space. So that's where we would want to increase our exposure. In the mid cap, 3% which you see on the passive side is not through the mid cap index directly, but it is from the alpha low volatility index, because that's a index which takes care of Nifty 200 components. So that's the overall allocation, how it will be a post rebalancing. Over to you, Anand.
Okay, so I've asked, well, people may ask, but there are a set of questions that I already have from a set of people. So now that you're moving away from passive, so it's about 40% moving away from passive. I also presume that there will be an increase in cost because active funds will also be coming at a higher cost. So what is the collective cost increase? If you could just give us the note.
Yeah. So earlier in our composition, we had more of large caps, less of mid and small caps in the overall portfolio on the index side. So overall, the expense ratio was around 0.65. Now, post adding 40% of the money into the active space, the expense ratio will move up to 0.95 to 1%.
So
But
about
that's the trade-off which we're trying to see from an active allocation, active fund manager trying to provide the alpha on the portfolio by doing an active selection.
Roughly about 0.3 to 0.35%.
Yeah, it's a 0.3% on an annualized basis. So if you are going to give a number on 100 rupee, it's a 30 paisa increase.
Okay, two more questions. One um, is this only for the money that is already invested, or are you making any changes on the SIP also?
So both the things, we are changing the existing portfolio because rebalancing as an activity is for changing the portfolio today for tomorrow. So
Right.
that is the thing which we are changing the existing portfolio as per the allocation I've mentioned. Now, since I'm moving the money as per the new allocation, I would also want to change the SIPs so that the money where I'm more comfortable, where the money should flow, should also be into the SIP structure.
So both the changes will happen, and how long does it take generally? I mean, how long do you think this entire shifting exercise will? I mean, what do you require from an investor?
So the people who are invested through our Mira Money platform, it's a very simple process. It's a one-click approval process where we send out the notification, the rebalancing notification on your app, and once you click onto the approval, provide the OTP, automatically the rebalancing activity takes place both on the portfolio side and also on the SIP. So it's as simple as one click of a button. And while we will be sending rebalancing notification, there'll be time that you might skip one of those because you might be busy with your work or a weekend. Our team, as part of our customer service team, and we, along with Naveen, myself, Anand, we'll also be reaching out to one of you if you would have missed the rebalancing, so that all the portfolios get rebalanced as per the allocation where we want the portfolio to be.
Okay, there's an interesting question from Anupam Mohit. Should we continue SIP in index funds or move entirely to active funds?
Yeah. So index fund as a strategy is different from how the active funds are, active fund strategy which we have. So it's about an approach which we would want to take, whether you would want to have an index strategy on your portfolio or a pure and pure active strategy using a fund manager doing the calls for you and we taking the allocation calls. So in the current market, what we currently believe is active funds generally are better. Overall active fund exposure will be much better on your portfolio, so that the churn which happens inside by the fund manager due to the economic changes which is happening or on the valuation side, so the active fund manager is in a comfortable position at this point in time. So that's where the cycles kick in, where index sometimes might be better and active might be better at some times. Overall, going forward, do I see a very major change between an index or an active? It might be a percent here and there. I feel very comfortable with both the strategies what we have. But if you are sticking to an index, we would want to have an active element at this point in time. Going forward, whenever we believe that the indexes are now going to perform better than the active, is where we move again the portfolio from active to a index portfolio also to an extent.
Yeah, so in another way, Anupam, if there in the next 2-3 years, if you see, I mean, I think personally, I think active should do better than index. So I would do my SIP in index, but it is not that index funds are, strategy is over. It can be continued, but the next 2-3 years may be a little underwhelming
Yeah.
for index fund versus an active fund. Mohit, one more question, or Naveen, one more question is: will one need to increase their existing SIP after rebalancing? Is there an increase in SIP amount?
No, there is no change in the existing SIP amount. Whatever you have been doing is where we continue to have.
Okay. So, Prateek, right? Prateek, Prateek, the minimums remain the same. You don't need to increase it, but ideally, this is a market that is, I would not say is on sale, but definitely is at a discount. So, it is a very good time to increase your
Yeah.
SIP for sure. That way, yes, but by doing this rebalancing exercise, we are not asking to increase the minimum. That is for sure. Chiranjeevi says, is there asks if there is a rebalancing in sector rotation baskets?
Yeah, so sector rotation, we constantly keep looking for better sectors to invest in. Like previously we had done, we moved out of auto, got into IT, uh, and we had in we had in momentum, we got out of there and got into business cycle. So we constantly keep looking out, and whenever that is a bit of an aggressive strategy. Whenever we see an opportunity, we'll obviously intermittently will keep asking uh, your approval for rebalancing. Uh, so yeah, sector rotation not along with the this rebalancing right now, but sector rotation can come at any time.
Yeah,
And
Chiranjeevi,
we'll
the whole idea about sector rotation is we will be looking at undervalued sectors or showing sectors showing momentum. Like what we picked out in auto was more of a momentum story, and when we picked out IT, it was a value story. I think there may be a change coming in, but we don't see that happening like what Naveen was mentioning right now. Along with the core portfolio, maybe about a couple of months from now, you may see some changes. We may also see FMCG, which is my favorite sector after tomorrow, or consumer as a segment. But we don't know. The team will take a call and then make the changes in the sector portfolio. Milind, any change with investment for seasons flavor? In fact, there's one change that we expect in the seasons flavor, Milind. That is a name change, because what I think that we have invested, Naveen, Mohit, and their team has invested is in a we it's a decadal story. This is like a story which will run for decades. There'll be more and more focus on the government to build power, to build infra, to build manufacturing as the next thing that will run. The theme will run for many, many decades. And I think we may not make any changes because yes, it has started on a not the best note. It is down by about few percentage points, but we believe that it's a decadal story, and we may not change the portfolio very soon. What's your take on so Anupam, good question. What's your take on your investments and other investment baskets? I'll simplify it, Anupam. So yeah, I know there are multiple baskets today. Some catering to high risk profile, some ultra risk, and some catering to not so average or moderate risk, and then some catering to low risk profiles. If you're an investor who's got a decent timeline from here, then I would say 70% maybe of your money or 60% of your money can be in core baskets, 20-25% can be in sector rotation kind of a basket, and 10% definitely you can add as a diversification. You can look at our international basket. I don't know how long it will last because you never know, they may hit the ceiling on set by RBI. So till it lasts, I think you should use that basket to invest. So 70-20-10 or 60-25-15% is the kind of allocation that you can have in the first three baskets that you see. Thanks, Chiranjeevi. Okay. With India's, okay, Shishir has sent me a message, which is my favorite topic. Naveen, maybe you can address that. With India's budget introducing tax cuts and potential RBI rate cut, right? Do you see FIIs, especially looking at large caps, because the dollar returns have been muted? And if the interest rate cut happens, will it make India unattractive to them? Thanks, Amir. Thanks, Shishir, for a very good question. So net
so
is if the interest rate is cut, will FIIs come to India or ignore India?
So, so your concerns, we believe RBI and government has the same concerns. Uh, it is not just about the stock market for them. It is the uh, FII holding which they have. They don't want to lose it because it is a very powerful tool for them. So that is one of the reasons why the government is keeping the fiscal deficits in check. If you see, uh, also the government, the Indian bond market has been fairly not much adverse movement there compared to the US bond markets where the interest rates have gone up. And and this is something constantly is being watched. Even if the rate cuts are going to happen in February, or probably the chances will be higher later, uh, they will definitely be watching out for the dollar outflows. and they'll be taking action based on that. So having said that, we constantly watch the dollar outflows, uh, not the FII outflows which happens in the mutual fund markets and in the stock markets. We constantly track that. Uh, it is a though the outflows are still happening, it is happening at a stable level right now. Uh, it is like it there was a big bump up in September, October. Now it has reached a stable level, and we expect because of the current market correction and some better opportunities now in the because of the budget and all. uh, First the outflows will reduce is what we feel. Then it'll stabilize, and if the growth comes in, uh, like some of the things we track are how the GST collections are happening, which eventually leads to the GDP doing better. The excitement comes back in, then FIIs will be back in. So I am sure that is at the corner of the government and the RBI's eye when they took the decisions which they have taken now. All of them want FII money to come back in, and the decisions are being taken in that direction. So uh, we are hoping it'll happen within the medium term. The first thing is stabilization of the outflows should start happening.
Yeah. In fact, I think even the USD yields, US dollar yields are also coming down off late. I saw about
Yeah.
30 basis points kind of a correction. So maybe that is also good. And DXY, which is a US dollar index, is also looking like it has peaked out. It is already looking lower. Let's say I've also seen that Trump likes not strongest of the currencies. So it looks like we may stabilize, and that's the first step, as you were saying, Naveen. And then maybe we'll look at adding more money. So even if they stop selling, I think that itself is good enough for Indian economy for now. One other question that someone asked me was, thanks, Ishir. One other question that someone asked me was, what about taxes? Right? When you do this rebalancing, we will be incurring taxes. Is it all worth it, Mohit? Do you think by paying 20% or 12.5% tax, is it worth it?
Yeah. So currently in the portfolio, what we're trying to rebalance is about 40% of the portfolio. So it's not the entire portfolio, first of all, which is getting rebalanced. To understand taxation for rebalancing, the portfolio has to be looked from a very forward-looking measure, right? So if my alpha generation, which is going to happen, or the capital protection which is required on the portfolio, if that delta is bigger than your taxation, then it is a payoff which happens end of the day. Now, not doing a rebalancing and taking down the portfolio, if let's say it is heavy towards mid cap and that has a 20% decline from here, which is if anyone asks me if it is possible, to an extent it could be, because the valuation is still very much expensive on that side, and especially on the mid and small, as I mentioned. So I would want to protect the capital and put the money into the large cap space where it is more or less comfortable. So the beta in a way is like, if I see a decline of 5-10% in the large cap space, the mid caps can go down by 20-25% also. So that's the overall thing which has to be looked from a very forward looking measures. Uh, there will be taxes, but if let's say you had invested in the last 6-7 months through your SIPs or through your lump sums, quite a bit of your portfolio might be on the negative side of it only. So it might just help you create means book your losses also for the profits which you would have created for the first half of the calendar year of 2024. So according to me, it's going to be a net zero sum game as of now, if for the last 6 months of investing which you would have done. But my more bigger point is, from a forward looking measure, I would want to do the rebalancing for creating alpha, plus also trying to protect the capital.
Okay, so yes, we pay taxes, but it is well worth it because one, let's say, I mean, I have a different theory on this also, Mohit, is that let's say if I had done this rebalancing a couple of years back, I was paying, and at that point in time, I had have paid only 10% tax. Today, I'm paying 2.5% more, right? So, while tax is an important consideration, it is not the consideration when we do the rebalancing.
Yeah.
Look at all the angles, make sure that the portfolio is rightly valued, portfolio is bound for growth, capital is protected, and that's when we take these calls of exiting. Otherwise, we can do it frequently. It's very easy for us to ask you to exit, but we make sure that we look at all those angles and then say, okay, it's mandatory now that for you to exit, and it is well worth it. It's what my honest confession is. I think with this we have question that I had from people. And here, okay. Any other questions, people who have joined here, please let us know. More than happy to answer them. Otherwise, we are okay. So any other questions, if you have, please let us know. People are joining in now. Let, otherwise, I think we have done with the presentation. We have spoken about the budget. We have spoken about the rebalancing. And yeah. Okay. Any other questions or any other clarifications? Okay, so I think with this we are thanks Milind for the appreciation. Thanks Shishir. By the way, if you feel free, if you have any questions, do write to us. Do contact Pooja. We our customer center number. You can always call. Thank you Shishir again. Thank you Milind again. More than happy to have you. And by the way, we have moved to a newer location, slightly bigger, better location, and this is in Outer Ring Road, Mahadepura. If you have, if you're around there, if you work there, please feel free to, drop by, have a coffee, we'll chit chat, and then figure our way out. And please do spread the word that about Miraman. Thank you all for joining in. Thanks for the appreciation, Dharmanshu, Narasimha. Looking forward to seeing you all someday. Thank you. Thanks,
Thank you so much.
Thanks, Naveen. Bye bye.
Thanks.
Thank you.